Hello and welcome to Upstack America's Oracle EBS Financials Functional Training. My name is Bob and I'm the lead senior consultant for Upstack America. And I have Victor, who is also a senior consultant. And today we are handling lesson 3 of the fixed assets module. And Victor, please walk us through.
Thank you, Bob, for the introduction. Welcome everybody to this lesson in our Financials Functional Training series. In this lesson, we are going to take a look at FA functionality and the monthly cycle, or should I say the periodic cycle in FA. We talked about FA functionality a bit. We are going to look at it in just a bit more detail so that we can also now put it all together when we talk about the periodic cycle. And we are also going to look at books, namely we are going to look at corporate books, tax books, budget books. We are going to see what are the features of each and what they are used for. Okay, so that is our agenda for this lesson. So let's get started. So talking about FA functionality, or what we can call the business processes in the FA module. We mentioned this when we were doing our introduction lesson, and we said that the main functionalities of FA can be grouped under asset management and depreciation functionality, okay? And we said that under asset management, we have a couple of transactions, you could say, or activities that you can do to manage your assets, including additions, adjustments or transfers. We also have retirements, and of course, finally, we have depreciation. So let's talk about each of them so that we understand what they involve before we can now go and tie them to the monthly cycle. All right, so let's start with additions. You can add new assets once they are acquired. You can add them to your books. That is basically what we call addition. And the main thing we'll mention about addition is that addition can be done in two broad ways. One is manual addition, whereby you go through to the manual, to the asset workbench and do manual addition of an asset. Basically, you key in the details of the asset, all right? And under this manual method of additions, we have also two subgroupings, which are quick and detailed. And the difference is just the amount of detail that you enter when you're doing a detailed addition, and a quick addition, you enter a limited amount of information, mostly the required information. So we are going to see what kind of information this is once we start doing additions, or once we start doing our implementation on our module. And of course, the other way to do additions is through mass additions, or what we call importing, where we said you can import the assets from where? From projects, module, or payables, okay? Because of course you have to pay for an asset to acquire it, and the purchase side is managed by the purchase ledger, or the payable sub ledger module. So that is what we call mass addition when you're importing those assets from those other modules, namely the payables and projects. So additions, manual or mass addition. Manual is divided into quick and detail. All right, and then mass addition is when you're doing importing assets from the subledger modules, such as the project and payables. So let's go on to the next activity, which is adjustments or transfers. And basically, what this means is when you're doing adjustments, you're changing some details about the assets that you already have in your books. Okay. So some of this might include changing the assets non-financial information or non-financial details, maybe such as the location or something like that. All right. You can also reclassify assets. This is all under the activity of adjustments. Some of the adjustments that you can make. You can reclassify your assets. You can also adjust financial information. All right. Some of the financial information you can adjust is like what? Salvage value. There's a place where we talked about salvage value in our previous session, so you should know what that means. You can also change the original cost of the asset if there are changes that have been made or have occurred in terms of what you paid for that particular asset, right? And also you can do transfer of assets. So we are going to understand what each of these activities are when we are going to do this in practically in our modules. All right. But those are basically some of the activities that fall under the adjustments in asset management. Retirement, you can't have assets in use forever. Of course, there are some special ones, such as land is a special asset which is assumed to have it has an infinite. It can be assumed to have an infinite useful lifetime, right? But most assets will have to be put out of use at some point. Machinery, vehicles, right? Even maybe things such as buildings, some of them will become too old and condemned or be sold, right? So that is basically what retirement means. When assets are no longer in service, they can be stolen, they can be lost, they can be damaged, right? So that is when you do retirement of assets. We have talked in detail about depreciation and what it is. Basically generating the depreciation expenses for the assets that you have in your books at every period. All right. And we know that depreciation produces accounting entries, which we talked about in our previous session also. But some of these other activities also produce accounting, such as when you retire an asset, all right, or some adjustments that you can make also produce accounting. So when you make some adjustments to the financial information, accounting could be created for those adjustments that you make. So that is a basic overview of the functionality, or what we can call business processes associated with the fixed asset module. So how do they fit with the periodic cycle of in FA? So this is what we can show as the periodic cycle. You open periods, okay, you manage periods. Once you manage periods, you could carry out any of these asset management activities that we've talked about, additions, adjustments, retirement. These are not mandatory. Okay, if you do not have any assets to add, then there's nothing you can do about that. You can't carry out additions. If there are no adjustments to be made, then there's nothing you can do about that. You won't carry out adjustments. If there are no assets to be retired, then you can't retire anything. So we can say these ones are done when they need to be done. They're not mandatory parts of the cycle. However, you have to run depreciation for the assets in your books. Okay. So depreciation will have to be run at the end of every period. You can run depreciation at any time during the period and as many times as you want. All right. But however, also as we will see, in order to close periods in FA, you have to run depreciation. So you can run depreciation without closing the period, but in order to close the period, you have to run depreciation. You will see that these are options that it's an option that you select. When you're running depreciation, you also select the option whether you want to close that period or not. Okay. But this is a good overview of the FA periodic cycle and where each of those business processes that we've talked about fall. So the thing to remember is that these asset management activities are as need arises, right? If there are additions to be made, if there are adjustments to be made or retirements to be done, you'll do them, but not mandatory. But depreciation has to be run for the assets in your books. Okay, so now let's move on to discuss about the books, and we'll start with the corporate book, which is the main one. And we say this because the corporate book is where we add our assets. All right, so when you are adding an asset, you're adding it to a particular book. You can think of it the way you think about your ledger. All right. So assets are to corporate book as journal entries are to the ledger. Okay, so you enter journals directly into your ledger, or you import them, right, from your sub-ledger modules. In the same way, you can enter assets manually into your corporate books, as we have talked about, manual addition, or you can import through mass addition from the relevant sub-ledger modules such as Oracle Project or payables. So in order to have a functioning FA module, at least one corporate book has to be in place or created. So it says here asset book. This should be corporate book. It's tied to a ledger, and that is the ledger where the accounting entries are sent. So what accounting entries are we talking about? Depreciation entries that you run every period will be sent to that ledger. All right. There are also other entries such as we have said when we do adjustments or some retirements. Okay. So you have to tie your corporate book to a ledger, and that is where this all accounting entries are sent. So in that case, you can have more than one corporate book associated with a single ledger. Okay. So for example, if you have two companies, all right, and you want to manage the assets separately in different books, but those companies are represented as separate balancing segment values on the same ledger, then you'll have two corporate books pointing to one general ledger, both of them sending their accounting entries to that same ledger, but of course with different balancing segment values to represent the different companies which they're sending accounting entries for. And of course, you can have each corporate book pointing to its own ledger if that is what your setup looks like. So when it comes to accessing your corporate book, I don't know why I keep on writing asset book instead of corporate book. So apologies for that mix up. Should say corporate. So in terms of accessing your corporate book, this is how you access it, okay? So one thing to highlight is that one, FA module is not part of the multi-org. It does not use the multi-organizational access concept or concept in terms of securing data, okay? So when you want to grant access to a particular book, what you have to do is you create an FA organization, all right? Remember we talked about some of these system organizations that represent entities in the real world, such as business group, inventory organization, right? We talked about this when you're talking about multi-org, but I insist that FA is not part of, does not use the multi-org structure, but you have to create an FA organization, which you can create in your under your human resource responsibility, the same way we did when we were creating organizations such as the business group, okay? And then you assign that organization using profile option, security profile, and then of course you will assign that to a responsibility. So the users given that responsibility will be able to see the details contained in that particular corporate book, such as the assets and all the details concerning those assets. You can have this kind of setup on the right, whereby one responsibility has access to more than one corporate book by assigning different FA organizations to the same security profile, which is then assigned to a single responsibility. So maybe this is a responsibility can be assigned to like high-level users or super users or something like that. Person who you want to see this information across multiple corporate books. But basically, this is how you grant access to your corporate books. You create FA organizations, which are then assigned to a security profile, which is then assigned to a responsibility, okay? Now let's talk about tax books, all right? And what are tax books? The first thing to note about tax books is that they are optional. You don't have to create them in order to have a functioning FA module. The other thing is that they are tied to corporate books, okay? So what is the purpose of creating tax books? If they are optional, what purpose do they serve, and why would a client want a tax book to be created for them? So tax books can be used to record a different depreciation method for taxation purposes. Okay. I want you to think back the same way you can create a secondary ledger, right? So when you create a secondary ledger, it could be that your primary ledger is for corporate reporting purposes, right? This is the way the organization or the company itself would like to do their reporting. And by this, I mean that through the 4 C's that are associated with the ledger, okay? So on the corporate side, you may want to report on different dimensions. So you will have a particular chart of accounts with particular number of segments. Maybe you have a particular accounting convention. So for your corporate, maybe you want to use accrual method, okay? But as per the regulations given by the regulating authority, maybe the IRS, there's a particular way they want you to do your statutory reporting as per the regulations that they have outlined for maybe your industry. So maybe they want you to do cash accounting instead of accrual, right? So you would create a secondary ledger to serve these purposes. In the same way, you create a tax book so that you can have a different depreciation method which will produce different depreciation entries or expenses. And of course, this will have implications when it comes to what things like the taxes that you pay. So the reason why a company would do this, for example, is to take advantage of some like tax advantages or tax breaks that may be offered to that particular company, right? So if the regulating authority has allowed you to use a particular depreciation method, which could save you, from paying a lot of tax on your net income, then you can create a tax book so that through the tax book, then you will know how much to be paying using that particular method. But on the other hand, on your corporate book, you have another depreciation method for your own corporate purposes for the company itself. But on your tax book, you have the depreciation method, which you're going to be using to calculate your expenses and consequently the taxes you pay on your net income. So that is why companies would create tax books just so that you can have different depreciation methods. And this is a common practice in many companies, all right? So it's something, it's not like cheating or anything. This is actually something that is provided for. So that is why you would have a tax book with a different depreciation method as compared to what is in your corporate book. The other thing about tax books is that the assets are copied from the corporate book, right? Because you're dealing with the same assets, just that you're depreciating them using different methods, okay? And as a result, you can just copy the assets from your asset book from your corporate book to your tax book. And you can do what you call initial copy for the first time, whereby you copy all the assets, and then as maybe you add assets to your corporate book, you can go ahead and do a periodic copy to keep your tax book updated with the assets that are being added also in your corporate book. Tax books are also linked to the ledger. Why? Because as we have said, they also produce depreciation entries, which are different from the entries produced by your corporate books and the method associated with the corporate book. So they are linked to a ledger. However, there's a caveat to this. They don't just send the depreciation entries the same way the corporate book would send the depreciation entries to the ledger to which it is linked. What the tax book does is that it sends deferred entries. Okay. So what are deferred entries? Like we have said, the reason why we have tax book is because you want to use a different depreciation method, maybe to take advantage of particular tax breaks offered by using these depreciation methods. All right. So that means that there will be a difference between the depreciation expenses produced from your corporate book and the ones produced from your tax book, right? So what the tax book sends is the difference between those two expenses, all right? So maybe if, for example, in one period, based on the depreciation method, the depreciation expense from your corporate book is $100, but based on the depreciation method in your tax book, the depreciation expense is $150. So that difference in 50 is what the tax book will send to the ledger, and this is to avoid double entries. Okay, and like we have said, these differences in depreciation expenses will have an implication in the amount of corporate tax that you pay. Remember that you pay your tax on the net income, right? And the net income is equal to your revenue minus expenses. Depreciation expenses are part of your expenses, right? So the higher your depreciation expenses are, the lower your net income is, and therefore the lower the tax you will pay. So that is going back to why maybe a company will want to have a tax book with a different depreciation method so that they can reduce their tax liabilities for a particular period, or maybe during its initial life when the company is just starting. They don't want to pay too much taxes, right? So they use a depreciation method that allows them to reduce their tax liability. But anyway, those deferred entries are what is sent by the tax book to your ledger, while your corporate book sends the normal depreciation entries that it will produce once you run depreciation. All right, so we've talked about everything. They are linked to a ledger. Okay, so let's go to budget books. Budget books, just like tax books, are optional and are also tied to your corporate books. All right. The purpose of budget books is that they are used to budget for asset expenditure. Okay, so basically capital budgeting. You want to plan how much you'll spend for your asset acquisitions, or you're going to spend to purchase these assets. So you create a budget book. Unlike the tax books, you don't copy assets from your corporate books. You create budget assets in your budget books, all right? And budget books do not send any entries to your ledger, so they are not tied to your ledger. However, they are tied to your corporate book. So this is what it would look like if you had all these. Corporate book, of course, is mandatory, and you have to have at least one for you to have functioning FA module. And then you would have your tax book, which has a different depreciation method from your corporate book for purposes such as we have said, to take advantage of tax breaks offered by the government. And then you have your budget book, which helps you in planning or capital budgeting, right? So the budget book and the tax book are linked to your corporate book. The tax book is also linked to your ledger. The budget book, however, is not linked to your ledger because there are no entries being sent to your ledger, right? The other thing to mention is that you can have multiple of each of these other two books. So you can have more than one tax book linked to your corporate book, all right, with different maybe depreciation methods in each of those tax books. You can also have multiple budget books linked to your corporate book, all right. So we have covered the agenda that we had for this session. In this session, you should have understood the FA business processes, what each one of them is, at least at a high level, and where they fall in the periodic cycle. And you should also now understand what the corporate book, the tax book, and the budget books are, what their peculiarities are, their differences, right? How they work, what the purposes are, okay? And therefore, Bob, unless you have something to add, we are going to proceed from there in our next session.
All right, Victor, thank you so much.